In today's lead story, the Chicago Mercantile Exchange has announced a broad reduction in margin requirements across major metals contracts, effective after the close of trading. Gold futures margins have been lowered from 9% to 7%. Silver futures margins have been reduced from 18% to 14%. Platinum margins have been trimmed by 13%. This decision follows 6 consecutive margin increases implemented during the recent surge in metals prices. Those earlier hikes raised the cost of holding leveraged positions and coincided with a sharp decline in open interest in trading volumes. Participation among long positions fell significantly during that period. The latest move comes as registered silver inventories sit at critical lows, and pressure in the physical market is reported to be at its highest level in years. Notably, silver margins were reduced by 22% in a single adjustment. The sequence of these actions has drawn attention. Exchanges typically raise margins to cool market activity and reduce leverage. After 6 such increases, participation declined and open interest dropped. Now, with physical silver inventories tightening, the exchange has moved to make futures positions less expensive to maintain. Market participants are closely watching positioning data following this change, as the impact of the margin reduction is expected to become clearer in upcoming reports. Turning to the physical market, the latest midweek report shows a significant movement in registered silver inventories. In a single session, approximately 6 million ounces of registered silver were adjusted out across multiple custodians, including Asahi, Brinks, CNT, Delaware, HSBC, Loomis, and StoneX. That activity occurred simultaneously across 7 custodians. Registered silver inventories now stand at 81,235,000 ounces. Earlier in the day, the figure was reported at 87 million ounces. This reflects a decline of nearly 6 million ounces within the same day. The pace of the inventory drawdown is described as accelerating. Additional figures from the Shanghai Gold Exchange indicate that silver withdrawals are running at nearly 3 times the level recorded 1 year ago, measured on a year-over-year basis. At the same time, managed money long positions in silver are reported to be at a 2-decade low. During a price move in this cycle from roughly $30 to over $120, money managers reduced their long exposure by approximately 70%. Meanwhile, the physical silver market has recorded a structural deficit for 5 consecutive years. Paper positioning is described as the most bearish in 20 years, while physical demand conditions are characterized as the tightest in a decade. The divergence between paper positioning and physical market conditions remains in focus, though no specific timeline is attached to how that gap may resolve. Broader market ratios are also drawing attention. The COMEX gold to silver inventory ratio has declined to 1 to 10.7. The gold to silver price ratio stands at 61 to 1. In the gold market, leverage in paper contracts remains significant. For every single ounce of physical gold in deliverable form, 133 ounces of paper gold are reported to trade against it, a ratio of 133 to 1. This structure helps explain why sharp moves in paper markets do not always correspond with immediate changes in physical supply. Recent trading patterns in gold have also been closely observed. For 4 consecutive trading days this week, gold experienced sharp sell-offs beginning at exactly 8 a.m. Eastern Time. On Monday, gold declined by nearly 3%. Tuesday saw a drop of more than 4%, reaching $5,000. Wednesday recorded a decline of nearly 2%. Thursday followed with another 2% drop. Across those 4 sessions, approximately $4 trillion in paper gold value was erased, with each move initiated at the same time of day. At the same time, global gold exchange-traded funds reported net inflows of $5.3 billion in February. This marks the 9th consecutive month of inflows and the strongest start to a year on record. Total global assets under management in gold ETFs reached $71 billion, with holdings totaling 4,171 tons worldwide. In silver markets, Western spot prices are at $82, with futures at $83. Shanghai spot silver is at $93, with futures at $95. Reflecting an $11 premium. Silver briefly dipped to 80 before recovering to 83. The US dollar index is consolidating ahead of the upcoming non-farm payrolls release. Geopolitical developments are also influencing markets. Iran has launched what it described as its 20th wave of strikes, involving ballistic missiles and drones targeting United States and Israeli positions. Iran's foreign minister stated publicly that the country has long been prepared for this war and said, "We are waiting for them," when asked about a possible U.S. invasion. Russia has stated it will do everything possible to make a U.S.-Israel military operation against Iran impossible. Israel is reported to be losing $3.7 billion per week. Kuwait has suspended oil refining operations following the closure of the Strait of Hormuz. Iran has rejected both a ceasefire and negotiations with the United States. Financial markets have responded with broad declines. Nearly $1 trillion was wiped from U.S. equity markets in a single session. The S&P 500 closed down 1.44%. The Nasdaq fell 1.64%. The Dow Jones Industrial Average declined 1.69%. The Russell 2000 dropped 2.45%. Bitcoin also moved lower. Oil prices have risen sharply. Brent crude closed at $85.41, up nearly 5% on the session. West Texas Intermediate closed at $81, up 8.5%. Oil has moved from $55 to above $80, adding an estimated 50 basis points of inflation pressure and pushing projected CPI from approximately 2.4% toward 3%. Every $10 increase in oil is estimated to add roughly 20 basis points of inflation. At $95 per barrel, CPI is estimated at 3.2%. The U.S. Treasury is reportedly considering intervention in the oil futures market to address rising energy prices. Meanwhile, the dollar remains in consolidation ahead of the non-farm payrolls release. The recent CME margin reductions, combined with low open interest and thin participation levels, indicate that price movements could be amplified in either direction. Official inventory reports, margin announcements, and positioning data remain publicly available for verification, as markets continue to react to developments across metals, energy, equities, and currency markets.